Good day, fellow investors. We continue with our steps in our free stock market investing course. So I have my research platform, but there is also a stock market investing course for those that want to start thinking about investing, know the core principles, and of course it is for free and will always be for free. I have just completed the how to start investing, the 7 key steps to consider. I'm doing videos, did already the free. This will be number 4, but also all the steps are already there in a PDF form if you want to first read and then of course follow in the videos. Much more content. I'm going to revamp the course during this winter, so feel free to join and subscribe. It is, as I said, completely free. This is also part of my free investing course playlist, so this will now be video 6. I've already have 5 of them, and I'll add that to the playlist, and you can also check the link in the description below for the previous 5 videos. The last time we discussed how to invest for 10% per year. And today we're going to discuss, I think, one of the core principles of investing that is very hard to grasp, simple to explain, but if you can understand that, then everything becomes much easier. The thing is that owning a business is what makes you wealthy over time, not watching stock prices. And one might think when it comes to investing in stocks, it is about your stock going up, but there are some other forces that are much more important. Let's just start with what does it mean to invest like most people do, thus watching stock prices. So 2 years ago I made this video about the 10 growth stocks, the hottest stocks at that moment in time. It was January 2021, and I looked at those businesses, I looked at the fundamentals of those businesses, and the core thing was that those businesses were trading at crazy price to sales ratios. 33 times, 29, 90 times price to sales, not price to earnings, price to sales, 41, 36, 38, and those businesses were there in the ARK investment fund because of the promise that those businesses will change the world and nothing will be as it was. Unfortunately for investors there, since then things have been very ugly, and also for ARK. But the moral of the story here is not that it crashed. The moral of the story is that those were pretty much the same businesses here, and then when those stocks started going up, pushed a little bit by free money and promotion, but by various funds buying inflows, those stocks exploded, and by the end of 2020, ARK Investments and Cathie Wood were the smartest people on the block. And no one cared about the businesses, about the crazy valuations. All people watched is how they are getting rich as these stocks keep going higher and higher. Pacific Biosciences went up more than 10 times in less than a year. That was crazy times. Now, when the bubble deflated, everything is back to normal and back to earlier situations. But people got blinded by stock prices, and then often what happens is that those stock prices revert to whatever mean, and even often overshoot below that mean. That is stock prices going up and down, but that is not investing, that is gambling. What is investing for me is perhaps best explained by Warren Buffett owning Coca-Cola, and by this definition, where I think that if you can part with your money, invest it in a business, a stock, through a stock, and then be happy about reaping those rewards that only the business is offering, just the business. It can be dividend, you're happy with the buybacks, whatever, but you do not care where the stock goes up and down, then you are a real business owner. Now, this might sound a little bit like this, but let's go to Warren Buffett's Coca-Cola example. If you look at Berkshire's statement, he opened his Coca-Cola position in 1988 and then in 1999 added to it another 40% at a 40% higher price. So he really liked the business. I think he first paid 40 and then 55 per share at that time. Of course, now there was a split, so we cannot compare current and historical share prices, but why did Buffett put, if you look at his cost of his stock market portfolio, 1 billion for Coca-Cola, $500 million for Capital Cities, so the most money that he invested ever into something was Coca-Cola at that point in time, and much more than what someone would say was good diversification. So practically all the money he had, he put it in the company. And then what happened? Well, the dividend adjusted for stock splits went from 3 cents to the current 1.80. The price went from 1 to the current 58. So all good, there is a significant dividend, and you might say Buffett did well with his Coca-Cola example. He has been holding it for 45 years now, nothing wrong with that, right? Well, let me show you something else. He bought in 1989, based on the brand Global Growth and everything, and 10 years later his stock was up more than 15 times. Always the same company, nothing wrong with it, but his stock was up 15 times on a little bit improved growing business, but nothing that spectacular. And the P ratio, everything was different here. Here it was expensive. If we go back to the dividend yield there, it was less than 1%. When Buffett bought, it was 2.83%, now less than 1% for Coca-Cola. So we could say that despite the business growing and dividend growing, the business now was at least 3 times more expensive. And when you buy something expensive, then going forward, you might expect lower returns. And that is exactly what happened with Coca-Cola. So the stock didn't do much for the last 20 years. Practically nothing. Here it was above 40, now 33, with the 1% dividend yield that now grew to 3%. It is nothing spectacular. Imagine Buffett selling this anywhere here and just placing his money in Apple as he did in 2016. So the 20 billion, 15, 20 billion he had in Coca-Cola, if he had put it in Apple, that would now be 140, 150 billion. If he had sold Coca-Cola here for the 15 billion and bought his own Berkshire Hathaway, that would now be again 150, 160 billion. That is insane. But Warren Buffett did not sell, he kept it forever. Not thinking about other things, but thinking only about this. His annual income now is $736 million. Compare that to the total cost price, that is a 70% yield on cost. Because he is a business owner, he doesn't care where the price goes. He cares about the business and what the business is delivering. And now, if you can invest, later we can do whatever. We are individual investors. We don't own 10-20% of the company like Buffett, so he has some constraints in selling. But if you buy something and you're happy with the business, no matter where the stock price goes, then you are a real investing owner. This is more important for something else. Not that Coca-Cola's stock went up 15 times. If it had gone lower, he would have simply bought more. And that is the trick to investing. When you focus on business ownership, you understand what you own, which makes it much more easier later, no matter where the stock price goes. Warren Buffett owned Coca-Cola. If it had gone lower, he would have bought more, reinvested the dividend, built that wealth across time. It went just up. He didn't buy anymore. He didn't reinvest the dividend into Coca-Cola. He reinvested in Apple and made huge, huge returns. That is Warren Buffett. That is investing in a business, not in stocks.